In the first part of Chapter 13, we were looking at analyzing the financial statements of a company by looking at horizontal, vertical, or trend analyses. And in those, we were comparing the changes in balance sheet or income statements over time. Now, in the second part of Chapter 13, we're going to move into looking at ratio analysis. Now, a ratio analysis is still a way to analyze the financial statements of a company, but rather than looking at the change in a single line item from year over year, now we're going to be looking at two different items on either the balance sheet or the income statement and looking at how those items relate to each other and comparing how those relationships stand in the present period, where we expect them to go in the future. When we look at performing a ratio analysis, we're looking at the relationship between different items on your financial statements. So ratios are typically referred to in percentages or in a rate, or they can be discussed in terms of a proportion of one item in relation to another. Ratio analysis is one of the most widely used types of analysis in order to look at financial statements. Oftentimes, external users use ratio analysis when they're looking at whether or not they're going to invest in a company or whether or not they're going to loan money to a company. Ratio analysis is so helpful for two reasons. First, we're looking at how different items relate to one another. So we're looking at things on a percentage basis rather than looking at a line item and how it stands on its own. When we look at things as a percentage, we're bringing them to a common size. So we can look and more easily compare how one company reflects or how it compares to another company. Also, we're looking at how two items relate to one another. So we're not simply looking at how much cash does a company have on hand. We're looking at how much cash do they have in relation to what debts they need to pay off in the coming year. So we're looking at important relationships that help bring to light underlying issues in a company. And we'll look at that as we move forward, the specific ratios that we're going to learn in this class. As we move through these ratios, we're going to look at them in different categories. We're going to look at liquidity and efficiency ratios, solvency ratios, profitability, and then finally look at ratios that help us understand the market prospects of a company. When we talk about market prospects, we're looking at publicly traded companies. So we're looking at the value of a company's stock compared to different items that are important to people who might be investing. So let's move forward. We're going to look at liquidity and efficiency ratios first. When we talk about liquidity, we're talking about the amount of cash that a company has or the closeness to cash. Efficiency, we're looking at how efficiently does a company work? How efficient are their operations? So we're going to move through these. We're going to begin looking at what we call working capital. Working capital is a ratio that tells us the amount of our current assets that outweigh our current liabilities. In other words, it's telling us, do we have enough current assets in order to pay off our current liabilities as they're coming due? This is very important because if we do not have enough current assets on hand and we have liabilities that are coming due, we may go through bankruptcy and would cease to be a company at all. So working capital is very important. Next, we're going to look at the current ratio. The current ratio is really just another way to express our working capital. So the current ratio looks at the ratio of our current assets over our current liabilities. And this is again telling us, do we have the current assets on hand in order to pay off current liabilities as they're coming due? The higher this ratio is, the stronger or the more liquid a company is considered. The acid test ratio, again, we're looking at the ability of a company to pay off their current liabilities. However, the acid test ratio, although it's very similar to the current ratio, it's more stringent. So rather than including all current assets, it's only going to include current assets that are extremely close to cash, and we call those quick assets. So with the acid test ratio, we're only going to include cash, short-term investments, and current receivables. If you'll remember, a receivable is a promise to get what? It's a promise to get cash. And we're only looking at the current receivables, or those receivables that are going to be received as cash within the coming accounting period. Compare that if we go back to the current ratio. Remember, the current ratio included all current assets, so that could include things like inventory and supplies. Those items are not as close to cash as cash, short-term investments, and current receivables, which are simply a promise to receive cash. So the acid test ratio, while it's very similar to the current ratio, it's more stringent, meaning that they only include things that are readily able to be used in order to pay cash for the current liabilities as they come due.
Now the next couple ratios that we look at are all ratios that look at how efficiently and how effectively is a company running their business. So we'll begin with the accounts receivable turnover. An accounts receivable turnover is just a ratio that tells us how many times a company turns over or converts their receivables into cash. So this is looking at, are we efficient with making a sale, and when we make that sale, rather than getting cash, we get an account receivable. What we want to look at with the accounts receivable turnover is once we have that promise to receive cash, or once we have that account receivable, how quickly are we actually turning it into cash? So we calculate this by taking our net sales and dividing that by the average accounts receivable. Net sales, this is just our basic revenue number, but the average accounts receivable, we calculate this by taking whatever your beginning amount was in accounts receivable, add to that the ending accounts receivable, and divide by 2. Now this is just a little caveat. Sometimes you may not have the beginning accounts receivable number, but instead you have last year's ending accounts receivable number. Think about this. On December 31st, 2014, that was last year's ending accounts receivable. However, January 1st, 2015 is the next year's beginning number, so you can use last year's ending or this year's beginning number interchangeably. They're basically the same thing. So we just add those two together, divide by 2, and that gives us the average accounts receivable. So that tells us how many times in general in a year are we turning over our accounts receivable. How efficient are we with getting the cash that we're promised? Next, we'll look at inventory turnover. Similar to accounts receivable turnover, the inventory turnover tells us, okay, we're purchasing inventory. How efficient and how effective are we with turning that inventory into sales? So this tells us the number of times in a year that we are purchasing and selling our inventory. We want to know, does our inventory sit on the shelves all year? Or are we purchasing inventory and quickly selling it to our customers? We calculate that by taking the cost of goods sold, so this is an item from our income statement, and dividing that by the average inventory. Again, average inventory, you just take your beginning inventory, add to that the ending inventory, and divide by 2. Next, we're looking at the days sales uncollected. So again, here we're looking at how efficient and how effective are we with getting the cash that we're owed from our accounts receivable. Here we're looking at how frequently we are collecting the accounts receivable. So here we simply take our accounts receivable, whatever we have at the time in our balance sheet, divide that by net sales, and then simply multiply by 365. And that's going to tell us, on average, how many days are our sales sitting and waiting to be collected. Day sales and inventory, again, similar idea. We're looking at how effective are we with our inventory. rather than just looking at how many times we turn over our inventory during the year, now we're actually looking at, okay, if we're turning it over however many times, how many days does that translate to? So similar what we were looking at with our accounts receivable turnover and days sales uncollected. These ratios, our inventory turnover ratio and days sales inventory, are all looking at how effective are we with our inventory. We calculate this by taking our ending inventory number, divide by cost of goods sold, and then multiply by 365. And this tells us how quickly or how many days it's taking us to sell our inventory. We then have total asset turnover. Again, we're still looking at how efficient or how effective are we as a business. What we're trying to get at with total asset turnover is we're looking at, okay, here is the amount of money or the value of money that we have invested in our assets. By looking at total asset turnover, we're determining, once we've invested money in assets, what are we even doing with it? Are we creating sales with the money that we have invested in our assets? So let's look at that. We're simply dividing our net sales, so we're looking at what is it that we're producing by purchasing and investing in assets. Divide that by average total assets. Again, average total assets is the same as we've been calculating balance sheet averages on the previous ratios. So again, this ratio tells us how effective is the company at using the assets that they have to generate sales. Moving forward, we're now going to look at solvency. When we look at solvency, we're looking at the ability of a company to continue on in the future. Are they able to pay their debts? So we'll begin with one of the most basic. We're looking at our debt and equity ratios. So what we're doing here is we're trying to get an understanding of how does the company raise money. If you'll remember from Accounting 101, companies can raise money through using debt or equity. A quick refresher, debt is when you borrow money, whether you borrow money from a bank or some other type of creditor. That is debt. Debt has a legal obligation to pay back both principal and interest at some point in the future, and that's all determined by contract terms. Equity, on the other hand, equity is money that investors put into a company, and those investors then have ownership over the company. Not only do they have ownership, but when you're looking at things like stock, many companies that issue stock, these publicly traded companies, they give out dividends. Dividends are not a legal obligation. However, many companies pay dividends, so that's part of the cost of equity. There's both pros and cons to having debt or equity, and we're not going to get into all of those right now. But these debt to equity ratios are allowing investors or people interested in a company to understand, is the company more heavily relying on debt, or are they relying on equity? So to calculate your debt or your equity ratio, you simply take, for the debt ratio, you take your total liabilities or your debt and divide that by total assets. On the other hand, if you want to calculate your equity ratio, take your total equity and divide that by total assets. I want to note, just in case you've forgotten how to do this, here we're not necessarily given the amount of total assets. However, we know total assets are equal to the sum of our liabilities and equity. So here, where we're given the sum of liabilities and equity, that also tells us what our assets equal. If you'll remember back from Accounting 101, our basic accounting equation tells us assets equals liabilities plus equity. So for example, here when we calculated our debt ratio, that's simply taking total liabilities of $83,451, divide by the sum of your liabilities and equity, or divide by assets of $207,000. And that tells us that we have 40% or 40.3% debt versus 59.7% equity financing. Now, you can see here we're comparing, and you can see that this company is more heavily financed using equity as opposed to using debt. The next slide, we're going to calculate the debt to equity ratio, and this is a direct way to quickly calculate how much reliance a company has on debt versus equity. If you look at our debt or equity ratios, which we looked at on this previous slide, we're only calculating the specific percentage of total assets are relying on liabilities or on equity. So we're looking at each of these on their own. However, the debt to equity ratio compares the two against each other. We have our total liabilities divided by total equity. Now again, we're not going to get into a full discussion of whether debt or equity financing is better right now, but I do want to talk about a little understanding of the debt to equity ratio. The higher this ratio is, that means the more liabilities you have as opposed to equity. Now, if you'll remember, liabilities or debt by rule is a legal obligation to pay interest and the principal back to someone. Equity, on the other hand, is an investment and ownership that someone has in a company, and that owner may or may not receive dividends, but that is based on the company's discretion. So technically, liabilities or debt is more risky because it becomes a fixed cost that once a company gets into a debt contract, they're legally obligated to make those payments. So a higher debt to equity ratio can signal that a company is less flexible because they have specific payments that they're required to be making in the future. This company is also seen as more risky because if there's some type of downturn in the economy or their sales are decreasing, they're still required legally to make these principal and interest payments. Whereas if someone is more heavily financed with equity, when there's a downturn, they may choose to not make dividend payments. Whereas if you're financed with liabilities, you have to make those payments because it's a legal obligation. So therefore, you're more at risk of going bankrupt when you have a downturn for some reason. Now also, we can look at the times interest earned ratio. And this ratio is looking at with the money that a company is making, so the income that we're bringing in, how likely is it that we are going to be able to make our interest payments as they're coming due? So we calculate the times interest earned ratio by dividing the income before interest and taxes, divide that by our interest expense. Interest expense is easy. That's just going to be a number that we pull off of our income statement. However, income before interest and taxes. This is also going to come from our income statement, but let's talk about how you get to this. Net income is going to be the ending income. Remember, that's your revenues minus all of your expenses. But what we're trying to look at with this times interest earned is, as our interest payments are coming due, are we making the income required to pay them? So we want to look at our income before interest and taxes, because this income before interest and taxes is going to be the income that we have to use in order to pay interest. So we simply take our net income number, add back our interest expense, and add back our income taxes. Now, if you were given a multi-step income statement rather than just a single-step income statement, you would have a line item that already tells us the income before interest and taxes. But if you weren't given this information, you would just add back these two items to get the numerator for the times interest earned ratio. Now we're going to move into looking at ratios that talk about profitability. So we're looking at the money that we're bringing in, or the revenue that we're bringing in. What kind of profit are we actually making? So when we talk about profit, we're talking about the money that we keep after we're paying our expenses. A company can make all kinds of revenue, but what's important is what of that revenue are we actually keeping? What are we able to bring and build on in our company? So we're going to look at profit margin. We're going to look at the return on common stockholders' equity, and we're going to look at the return on total assets. So we'll begin with our profit margin. This ratio is going to tell us what profit or what income are we earning from our sales. This is fairly straightforward. We simply divide the net income by our net sales. The higher this profit margin ratio is, that tells us the more effective or the more efficient we are with keeping the revenue that we bring in. So in other words, if we have very high net sales but very low net income, we're going to have a low profit margin. And this signals that although we're able to make lots of sales and bring in a lot of revenue, our expenses are way out of hand and we're not actually making any money from all of those sales. Return on total assets, we're looking here, rather than just looking at some of the ratios we were looking at before where we were looking at total asset turnover. In those previous ratios, we were looking at what sales were we making with the assets that we have. Now we're going to take it one step further. Rather than simply looking at our revenue, we're going to look at what income are we actually making from our assets. So we calculate that by taking our return or our net income and divide by our average total assets. We already talked about how we calculate average total assets with some of our previous ratios, so we can just move forward from here. But again, the return on total assets is looking at not the sales that we made, but what income are we actually creating from our investments and our assets. Next, we're going to look at the return on equity. Return on equity is looking at, okay, we have people who are investing in our company. What type of return or what type of income are we actually making with their investment? So you can see here we calculate this. It's going to be our net income minus preferred dividends, and we'll talk about why we have to subtract those out in a second, and divide that by our average stockholders' equity. Calculate average stockholders' equity just like you calculate your average assets. You would take your beginning equity plus your ending equity and divide by 2. So return on common stockholders' equity. So rather than simply having our return or our net income in our numerator here, I want to note you have to subtract out your preferred dividends, because what this ratio is looking at is how well is a company using the money to the benefit of their stockholders. Now, preferred dividends, and again, this is something you would have learned at the very end of Accounting 101, but preferred dividends are dividends that are promised to our preferred shareholders. So this is money that is not at liberty to go to our common stockholders. So when we look at the return on common stockholders' equity, we only want to look at the portion of the net income that would be available to our common stockholders. Because these preferred dividends are legally obligated to go to the preferred shareholders, we're going to exclude those from our numerator. Finally, we're going to look at a couple ratios that talk about the market prospects of a company. When we calculate a price to earnings ratio or a dividend yield, we're comparing whatever our current stock price is to different numbers that help give us an idea of the risk of a company, opportunities for growth, or even the return that investors could expect to get for their stock. So let's look here at the price to earnings ratio. We calculate this by taking the market price per common share and dividing that by the earnings per share. Market price per share, that's going to come from the stock market. This is not something that you're simply going to pull off of your financial statements. Earnings per share, you would have learned this at the very end of Accounting 101, but earnings per share is looking at the earnings or the income that you're making on a per share basis. And what this tells us It's a general guideline in looking at the value or the share price of our company compared to the earnings or the income that we're actually bringing in on a per share basis. You want your earnings or your price to earnings ratio to be high, because the higher this is, the more opportunity that you're perceived to have for growth, because that means that the market has higher expectations from your company and you have room to continue growing. On the other hand, we can look at our dividend yield. Dividend yield is going to be calculated by taking your annual dividends per share. So this is not looking at the total amount that you pay in dividends, but it's looking at the actual dividends that each share of your stock gets, and divide that by the market price per share. And this just gives potential investors or investors an idea of the return that they could expect to get compared to the actual cost of their shares. So we've gone through a number of ratios, and this slide here is an excellent thing to use as you're beginning to work through some of your homework. So again, this is just a summary of the very many ratios that we learned. If you were following along with the PowerPoints that are given on Connect, you'll notice that I skipped some of the PowerPoints, or if you were simply following along by flipping through your book, you'll notice I didn't cover every single point. This doesn't mean that those areas of the book or the slides are not important. It's just things that I didn't have a whole lot to add, so you should read through those on your own because that information is important, but I didn't want to spend time going over things that we didn't necessarily need to in our lectures.